Hey guys, welcome back to a brand new video. I'm RexFinance, and man, if you haven't seen it, the world is ending. Flames everywhere. Boom, pow. Ooh, all over YouTube. Yeah, and CNBC, everywhere in the stock market media. The world is ending. The stock market rally won't last. This is a sucker's rally, a bear market rally. We're still yet to see another 50% drop in the markets. The world is ending. Being a realist here, my world seems pretty good outside. Yeah, it's less than 30 degrees out, but it's sunny. It's sunny out. My world is not ending. And I have some data that I'm going to share in this video, lucky you, that the media and other YouTubers that are trying to paint this picture so they get all the viewers and the clicks aren't telling you. I have data that is showing us that this bull market is probably here to stay, or it's coming back if it's not yet here. But looking at the stock market's performance throughout 2023 so far, it looks pretty dang good. And I just want to say, yes, very cliche, the world is ending is a very good stock market bottom. Like, what's more cliche and telling than that when most investors, I shouldn't say most, but a lot of investors and personalities and influencers are painting that picture of doom and gloom. It's a lot like the top of the market in November of 2021 or February of 2021 was another top in the markets where everybody was like, oh, I'm going to go purchase my new green Lamborghini tomorrow. Oh, I made $10,000 today. Tomorrow I'm going to make $20,000. It's a great sign of a market top. This is a great sign of the market bottom. This on the screen here is a great place to start. This is something that nobody in the media, nobody on YouTube has talked about. It was swept under the rug, but according to JP Morgan, retail traders unloaded $3.1 billion in assets over the past week, which happened to be the first week of January, making it the third worst week of net selling in history. And shocker, if we go to the chart of the NASDAQ, that works out to be the latest bottom we had. And capitulation, this huge capitulation event is something that I've heard everybody talk about that they are looking for so they can signify or signal the market bottom. But they're ignoring this. The third worst week of selling in history. I almost guarantee that 99% of you watching this video did not know that that was the third worst week of selling in history. That, my friends, is capitulation, and the media and other YouTubers had completely ignored it for whatever reason. Just for the sake of fun, if we mark that bottom in the first week of January in the capitulation event, since then, the NASDAQ is up 11.5%. Quite a move. And it's kind of pained me. Even my members, my own members in my Discord server, seems like the vast majority of them have gone bearish. And what do you know? As soon as most retail investors are buying puts and are bearish on the stock market and the economy, the stock market flips and starts going up. So if you're a bullish, I need to balance this out a little bit. Hit the join button below, or I'll let you in on a secret. I'll pin a comment in the comment section, obviously, where else would comments go, that leaves a link to my Patreon page. You can join my membership for $3 a month. Limited spots only for that price point, though, but $3, come on. In this day and age of inflation, $3 in 2020 money, that's worth like a penny. Join the membership. I also just have a quick favor to ask of you. This most recent video that I posted 2 weeks ago, it didn't do very well view count-wise, but if you go back and watch this video, damn, I was right about basically everything I said in that video, which is tremendous. It makes me feel great because, woo, I've been on the other side of that where I have been very wrong. But yeah, just help me out. Give it a little bump in the view count there. It was one of my most engaged videos, but, the view count's been a little bit lower, and I was kind of asking for it. I didn't post for 2 months, but we're back now. We're back, so they'll give this video a bump if you're willing to do so. One of those things I talked about in that video was the fact that I thought deflation would hit the print, hit the news in this most recent CPI data release, or the one that's going to come out in February showing January data. Well, I was correct. For the month of December, there was deflation across all items of 0.1% month over month. Deflation. Now, if you're into the year-over-year numbers, we had 6.5% inflation year-over-year in the month of December, but 60% of the items in the CPI report year-over-year were in deflation. The year-over-year figures, prices were going down. So that should tell you a lot. I don't think anybody disagrees that inflation is on its way out of here. Even the bears, they're more concerned with what the Fed is going to do and how the economy is going to conduct itself or survive or protect itself. I don't know. But another thing that I've been saying, and I mentioned in my previous video, was that yes, I think the economy is going to slow down, but much, much less than most people anticipate. This morning, we got news. It's been on the screen, so maybe a screen peeked, looked at, I don't blame you. The U.S. economy grew at an annual rate of 2.9% in the fourth quarter. That's back-to-back quarters of GDP growth. I could swear, looking everywhere on YouTube and on CNBC or CNBS, as some of us like to call it, or even Bloomberg, any sort of financial outlet, you would have thought the economy was contracting and not doing well. 2.9% expansion, not contraction, expansion. The economy is growing. That is tremendous. The economy is holding up very, very well despite these interest rate hikes. And a lot of people think that, oh, we're going from 0% interest rates to 5% interest rates. That's terrible. But they forget that interest rates between 4 and 5% have generally been very accommodative to an economy. A 4 to 5% federal funds rate is hardly restrictive, if restrictive at all. I understand we're coming from 0% interest rates. We're used to free money, basically, but 4 and 5% interest rates on debt is still very, very low. In other shocking news, this morning we got, okay, I'm going to stop talking like that. We got news that jobless claims fell despite mounting layoffs in the tech sector. Again, something I talked about in my most recent video, but in the most recent data we got this morning, there were a total of 186,000 unemployment insurance claims, down 6,000 from the previous week's total of 190,000. And if I look at my notes, I apologize for not looking at the camera, the estimate was for jobless claims to be 205,000. We came in at 186,000. People are so confused. Oh my gosh, I'm seeing tens of thousands of layoffs in the tech sector. How are jobless claims not going up? Well, the answer is there was a lot of bloating. There is a lot of bloating in the tech sector. The tech sector had its best years of growth throughout the pandemic, and I'm sorry, it's a business cycle. Eventually that business cycle has to end. You have to cut off the fat, and that's exactly what's happening here. I don't know a single blue-collar worker that has been fired or had their pay cut. I have seen tens of thousands of corporate workers that add very little to the bottom line profits of a company get fired or their pay go down. Let's just think about Twitter. Like it or not, Elon Musk came in and bought Twitter, and he downsized the company like crazy. Tens of thousands of layoffs. And Twitter arguably is performing better than ever. They've been improving the app faster than ever with half the amount of workers. That is bloating. That is fat that has been cut off of a company. Another example is Amazon's layoffs. Sure, they're laying off the corporate workers, again, who add very little to the bottom line of a company. But the warehouse workers have not been fired. Their pay is not going down, and in fact, Amazon can't find enough warehouse workers. Another example, this small little company called Apple, I don't know if you've ever heard of them, the CEO, just overnight, this was decided by shareholders, is going to take a 40% pay cut from his 2022 total target compensation. 40% pay cut overnight, down to $49 million. And if I look at my notes again, I apologize. He made $83 million in 2022. Overnight, his pay is going to be cut by 40% to $49 million for 2023. And you know what? Tim Cook's not going to feel an effect from that. And you know what? That's another example of bloating. Fat needs to be cut off of Apple. And look what's happening. As long as the blue-collar workers keep their jobs and don't take pay cuts, the economy is going to stay strong. A lot of people are confused about that, and I don't know why. There's a reason that the layoffs are heavily concentrated in the tech sector, and not even just the tech sector, the corporate jobs within the tech sector. And the other bearish argument that people are making is that, ooh, we're pricing in a soft landing right now, and soft landings have never happened in our history when the Fed raises rates. Well, this time is very, very different. In no interest rate hike cycle of the past did consumers and citizens have excess capital in their pockets. This time they did. Let me show you this graph. We're looking at the United States money supply. Do you see this little bump here in 2020 and this little hook at the top where the money supply skyrocketed over the past 2 to 3 years? Well, yeah, that's what money supply has done over the past 2 or 3 years, meaning that consumers and citizens, and just in general, there is so much more money in the system than there ever has been before. This was a huge change, a huge increase in the supply of money. I realize over time, the money supply has grown pretty consistently, but you can see how it skyrocketed here recently over the last 2 or 3 years. And at no point in history when there was a rate hiking cycle did we see such money supply growth prior to those rate hiking decisions. What this means is that citizens and businesses and corporations can weather the storm better than they ever have been able to when interest rates go up, because they have excess capital that they can deploy if their pay does get cut, if their expenses do go up because of inflation, if borrowing money gets more expensive for them. They have excess cash and capital sitting on the sidelines to make up for that difference. No point in history have we ever had that happen. Again, do you know of anybody in the media or on YouTube that has talked about that or considered that? If you made it to the end of this video, you must like me, so hit the like button and subscribe. I appreciate it. I hope you guys have a great rest of your day. I'll be back with consistent videos from this point forward. I hope you're here to join me and tune in every day. With that, have a great rest of your day. Stay blessed. 10 toes to the ground. Chin up. Peace out.